Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Opendoor Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
And we are really strapping in for this one. I mean, Opendoor has been, without a doubt, one of the most volatile stocks to watch lately.
Oh, absolutely. It just had this massive momentum. We're talking a 90-day return of over 200%.
And what, 320% for the whole year?
Yeah.
It's a jaw dropper.
It really is. It's the classic turnaround story, but one that is absolutely fraught with risk.
So what kicked off this huge surge? I remember things really got going back in October.
They did. And it wasn't just retail enthusiasm. The real driver was institutional confidence. The smart money, as they say, started making some very big, very public moves.
You're talking about the Jane Street disclosure.
Exactly. Jane Street Group, which is one of the most sophisticated firms out there, disclosed they'd taken a 5.9% stake.
Which is, was it 44 million shares?
44 million shares. I mean, that news alone sent the stock flying. It was up over 16% in just 2 days.
And that's a huge vote of confidence. It forces everyone else, especially the analysts, to sort of set up and pay attention, right?
It does. We saw Morgan Stanley, for instance, have to play catch up. They raised their price target pretty significantly, from $2 all the way up to $6.
Which is still a bit conservative, but it shows they believe in the recovery narrative.
It validates it. And then you have the real outliers, like JP Morgan, with an $8 target. But that definitely stands out against the general Wall Street skepticism that's still lingering.
So for anyone just watching the charts, the technical picture looks, well, pretty great.
It looks fantastic. The stock is trading comfortably above both its 50-day and 200-day moving averages. That's a textbook confirmation of a strong bullish trend for momentum players.
But there's a price for that kind of momentum, and it's the volatility. That beta it's something else.
It is. The beta is 3.60, and we should probably break that down for a second because it's critical.
Right. So the market, the S&P 500, has a beta of 1.
Exactly. So a beta of 3.60 means that if the S&P moves up 1%, Opendoor is expected to move up 3.6%.
But the reverse is also true, and that's the scary part. A 1% drop in the market could mean a 3.6% drop for Opendoor.
Precisely. Volatility isn't a side effect here. It is a fundamental characteristic of owning this stock. It just magnifies everything.
Okay, so the technicals are strong, but volatile. That brings us to the billion-dollar question. Do the fundamentals actually justify any of this excitement?
That is the inflection point, isn't it? And you have to start with the sheer scale of the business. This is not some small startup.
No, their trailing 12-month revenue is, what, over $5 billion?
$5.18 billion. That's a massive number. But, and this is a huge but, that number represents a nearly 26% year-over-year decline.
And Q3 was even worse, wasn't it?
It was. Q3 revenue dropped almost 34% year-over-year. They're clearly feeling the headwinds from the tough housing market.
So they're shrinking the top line, which is never a good look for a growth story. And I'm guessing the bottom line isn't much better.
The bottom line is, well, it's still painful. Net income is still deep in the red. A trailing 12-month loss of $305 million.
And the margins?
Still negative, both EBIT and EBITDA margins. That tells you they're still burning cash just on their core day-to-day operations. That is the problem the turnaround plan has to solve.
Okay, but digging into the balance sheet, it's not all bad news. There's a reason they have the time to even attempt to turn around.
And that's the key. Their liquidity is surprisingly strong. They have a current ratio of 4.4.
Which, just for context, means they have more than 4 times the assets they need to cover all their short-term debts.
It's a huge cushion. It's their lifeboat. And we also saw operating cash flow swing positive in a big way in Q2 2025, around $823 million. So they are getting better at turning houses back into cash.
So they have a cash buffer for survival. But that kind of business model, holding all that inventory, it comes at a price. And that price is debt.
That is the other side of the coin, yes. The debt-to-equity ratio is high, sitting at 3.46. It's a capital-intensive, leveraged model.
Which introduces a ton of risk if the housing market suddenly shifts against them.
A ton. It's this fundamental paradox of the iBuying model. The liquidity keeps you safe day to day, but the leverage creates this huge systemic risk in the background.
And the Q3 results really showed that tension, right? You said revenue was above their own guidance, but below what analysts wanted.
Exactly. And the really critical number, the GAAP gross profit margin, slipped a little, It went from 7.6% last year down to 7.2%.
Which doesn't sound like a lot, but in a business that runs on volume, every little bit counts.
It really does. It shows they're still walking this tightrope, trying to keep enough volume moving through the system, even if it means sacrificing a tiny bit of margin. The pressure is clearly still on.
So this is the challenge for management. Bridging this gap between the messy reality of today and the hopeful future the institutions are betting on. What's the plan?
The plan is all about discipline, extreme cost discipline. They have been ruthless. They've cut adjusted operating expenses by 41% year over year.
41%. That's a massive cut.
It's huge, and that is the lifeline. That is what extends their cash runway and gives them the time, the quarters, not just months, to see this through. It buys them breathing room.
And they've also shaken things up at the top, bringing in new leadership.
Yes, a new president from Coinbase, a new CFO. It signals a real focus on fintech and tighter financial controls. And crucially, their pay is tied directly to stock price
Okay,
hurdles.
so their success is directly aligned with shareholders' success.
Perfectly aligned. They need the stock to perform to get paid, which means they need to hit that profitability goal.
Okay, let's talk about the competitive advantage.
Right.
Why would a firm like Jane Street make such a big bet here? It can't just be about flipping houses.
It's not. It's all about the technology moat. Opendoor isn't really a real estate company. They're a tech company that happens to be in real estate.
Using AI and all their data to price homes instantly.
Exactly. It's a proprietary platform. They're selling a streamlined, friction-free user experience, certainty, speed, convenience. That's something a traditional brokerage just can't compete with.
So that tech edge is what justifies let's call it a speculative growth valuation.
It's the only thing that does. And their growth path now is about leveraging that tech for better margins, not just more volume.
Meaning they're moving into things like financial services, mortgages.
Exactly. Capturing more of the value from each transaction. They've guided for a Q4 revenue to be a bit lower sequentially, somewhere between 800 and 875 million.
But the key is they're guiding for higher contribution margins.
That's it, between 5 and 7%. They're basically saying, we'll buy fewer houses, but we'll make more money on each one we do buy.
And all of this is building toward that one huge flashing goalpost that everyone is watching.
The 2026 break-even target. Management has put it out there. They plan to achieve adjusted net income break-even by the end of 2026. That is the finish line.
Okay, so let's bring it back to the near term. For anyone watching this stock over the next, say, 3 months, what are the key events to circle on the calendar?
The number one most crucial test is the next earnings report, the Q4 2025 release in early February.
And what are we looking for there?
We need to see if those cost cuts are actually improving the margins. They have to hit that 5 to 7% contribution margin guidance. If they miss that, the market will punish them, regardless of what the revenue number is.
Because it's all about the path to profitability now.
All about it. The second big catalyst is watching the institutional flows. We get the new 13F filings in early January.
Which will tell us if the Jane Street buy was a one-off or if other big funds were quietly buying shares in Q4.
Exactly. If we see broad institutional accumulation, that provides a much stronger floor for the stock.
Are there any smaller events that could move the needle?
Well, with a high beta stock, everything matters. You've got ETF rebalancing that can cause some volatility. And the holiday real estate updates in December will give us an early read on the consumer.
Okay, and then there's the speculative side of things.
Right.
What are some of the high-risk, high-reward rumors floating around?
Well, the M&A chatter is always there. And it makes sense. The value of Opendoor's data and its technology platform is immense.
So a larger fintech or prop tech player might see them as a prime takeover target.
Or even a big private equity firm that thinks the tech is undervalued because of the current operational losses. A buyout offer would instantly validate that core asset value.
And what about something from the company itself?
There's always talk of a potential share buyback. With their cash flow improving, if management uses some of that cash to buy back stock, that's a massive signal of confidence.
Any other buzz? Partnerships, maybe?
There is some unconfirmed buzz about joint ventures, maybe with a big mortgage fintech or a private equity real estate fund. A partnership like that would be a huge boost.
So let's try to pull this all together. Opendoor is. And it's definitely not a safe bet. It's a high-powered, tech-driven turnaround story that now has some serious institutional money behind it.
That's the thesis in a nutshell. Its future comes down to two things: flawless execution on that 2026 plan and navigating the housing market without getting crushed on margins. The stock price today is a bet on that future potential, not on what they're earning right now.
Which leaves us with the final question for you, the investor. If Opendoor pulls this off, if they actually hit break even in 2026, what does that say about the future of the traditional real estate agent? Is this less about a housing cycle and more about a fundamental disruption of how we buy and sell homes?
That's the multi-trillion-dollar question, isn't it? It's technology versus capital risk playing out in real time.
We'll be following Opendoor's Q4 guidance closely. Make sure you subscribe to Smart Wealth with Joshua so you don't miss our next analysis.